Welcome to the Stock Market Palantir. Today, we are going to talk about Plug.
Plug Power Inc. has become, the classic example of a high-stakes, high-volatility NASDAQ story. As we're looking at the data through December 2025, the company is just facing this complex and frankly highly dangerous intersection. You've got a critical liquidity crisis. You have serious political headwinds. The freeze of that big DOE loan guarantee and the legislative changes. And then you have these very specific market microstructure issues really suppressing the stock.
Absolutely. And that whole convergence has just hammered the stock, pushing it down, toward that critical $1 NASDAQ compliance risk. So the central question for us today, I think, is whether management's recent, very decisive strategic moves, we're talking about the debt restructuring, selling off assets, and that really aggressive pivot into the data center market, if all that represents a viable, calculated path to survival.
Or if those moves are just temporary, one-time fixes to get some cash in the door, which are ultimately just accelerating what I see as a structural financing death spiral through, inevitable and long-term dilution. My position is that the underlying financial gravity and the market mechanics here, they basically guarantee the strategy fails.
And I'll be making the case that conversely, the shift in leadership and this new focus on operational efficiency under the CEO, Jose Luis Crespo, has created a genuine, albeit very narrow, runway for survival. The actions they took in late 2025 were really the only realistic way to get through this so-called Hadrian winter.
Okay, so let's start by outlining why I see a path forward here. The key for me is recognizing the decisive action from the new management. This isn't just talk. It's a real pivot from the old CEO's visionary growth mantra to Crespo's much more hard-nosed operational discipline. And we're seeing that translate into real tactical financial defense.
But tactical moves don't fix a structural margin failure. They buy you time to fix the structural failure. Look at the November 2025 convertible debt refinancing. That was a hugely necessary defensive move. They managed to replace what was essentially 15% interest toxic debt, which was just crippling their cash flow, with much more sustainable 6.75% coupon debt that isn't due until 2033. That one move saved them critical cash on interest payments right away.
Flexibility that was purchased at the cost of a massive equity overhang, which I'm sure we'll get to.
But that flexibility is exactly what allowed the data center pivot. This wasn't some choice they made for growth. It was a savvy, tactical necessity to get capital when the usual green energy funding lines just froze up. The letter of intent to sell electricity rights and infrastructure for $275 million is massive. That cash injection covers, 2 to 3 quarters of their cash burn? It insulates them from the political shocks. And on top of that, Project Quantum Leap is showing results. Operating cash outflow was down 53% sequentially in Q3 2025. That's a burn rate of around $90 million. That is tangible proof that management is wringing efficiency out of the business.
I come at it from a completely different angle. Those efficiency gains, while yes, they're measurable, they are completely overwhelmed by the underlying structural reality of the business. The company is fundamentally trapped in a financing death spiral precisely because it cannot and has not generated positive gross margins.
Well, that's the long-term goal.
It's the immediate crisis. Their GAAP gross margin stood at a staggering negative 67.9% in Q3 2025. This means for every dollar of product they sell, they lose 67 cents before they even think about administrative costs, R&D, or anything else. This core failure means they have to rely on external capital, always. And the way they chose to get that capital, that $375 million convertible note, it creates a structural nightmare. The institutional arbitrageurs who bought those bonds are now mechanically shorting the stock. It's called delta hedging. And they're accounting for, over 50% of the dark pool volume some days? It ensures any rally just gets smashed down.
You're describing the pressure perfectly, yes?
And that pressure guarantees the need for extreme dilution. The upcoming proposal to double authorized shares from 1.5 billion to 3 billion. That's a watershed moment. It's a signal from management that they see dilution as the only permanent solution, which guarantees a severe erosion of shareholder equity, and makes that slide below $1 and the NASDAQ compliance risk that comes with it highly probable. The root of the problem was losing that $1.66 billion DOE loan. That forced them into this trap. Let's focus on the market microstructure for a minute, because this is what I think separates Plug from a normal turnaround story. I'm sorry, but I just don't buy that the stock can escape its current trading range as long as its convertible debt is out there. Retail investors, they see the high short interest. It's near 25%. And they all scream short squeeze.
A misunderstanding of the capital structure for sure.
It is, because the data clearly shows this is purely mechanical, hedged shorting by quant funds like Goldman Sachs and Two Sigma. These funds bought the convertible bond, which pays them a nice fixed 6.75% coupon. To lock in that return, that arbitrage, they short the stock to maintain a neutral position. So what that means is they are not speculative shorts betting on the company to fail. They're just extracting that coupon yield.
And that's what creates the gamma trap.
Exactly. These arbitrageurs are perfectly hedged, so they will not panic cover. If the stock price goes up, sure, their short position loses money, but their bond gains value, so they stay neutral. They'll just sell more shares into the rally to rebalance. This gamma trap locks the stock in this tight downward drifting range. It just neutralizes any positive news.
I appreciate the precision of your analysis on the arbitrage mechanics. It is the most significant short-term headwind, but I think you're focusing only on the price ceiling, not the potential catalyst that changes the delta. I would frame it differently. This arbitrage pressure is primarily a function of the stock price being so low relative to the $3 conversion price of that debt.
It's a self-reinforcing loop.
It is. But if the new management can actually execute on Project Quantum Leap, if they can reduce that catastrophic cost of goods sold and the cash burn, the fundamental value will eventually rise. And when that fundamental value gets closer to that conversion price, the bond's delta increases. It becomes more sensitive to the stock price. That forces the arbitrageurs to manage their hedge by covering some of their shorts. The hedge funds are just mercenary capital. Their mechanical actions will actually start working for the stock price if the fundamentals shift and converting that bond becomes profitable.
But that requires hitting $3 a share or higher. Right now, they're losing 67 cents on every sale. How long do we wait for a fundamental shift that big? If Project Quantum Leap was so effective, why did they have to pivot so hard to selling assets just to meet basic liquidity needs? The arbitrageurs are comfortable because they see the same lack of fundamental improvement that I do.
Because the external environment changed faster than the new CEO could execute the long-term fix. They had to take defensive action immediately. You're right about the structural pressure, but you're ignoring the potential for that hedge to unwind if the company can just demonstrate a real path to break-even margins. Okay, so let's shift to dilution and the survival runway, specifically this monumental proposal to double the authorized share count to 3 billion. Now, I see why you think this is fatal, but let me offer a different perspective. This is not some aggressive growth move. It's a necessary life raft for a company in distress.
It's a dilution bomb. It guarantees long-term equity erosion.
It's a necessary defense against insolvency. If the retail investors, often mobilized by highly emotional sentiment online, if they vote against that 3 billion share authorization in January 2026, the company loses its only remaining currency. They have less than, 0.4% of their authorized shares left right now. Losing the ability to raise capital means they risk immediate insolvency.
They should have built a sustainable business model instead of perpetually relying on the capital markets.
Well, that's hindsight. Securing this capital runway, even through this extreme dilution, is the critical defensive move they need to make to avoid the stock dropping below $1. That would force a fire sale or a repeat of that damaging 1-for-10 reverse split they did back in 2011. Dilution is simply the price of keeping the NASDAQ listing and giving the new CEO the time he needs.
I'm just not convinced by that line of reasoning. Because while the capital raise is, I'll grant you, necessary for survival, the sheer scale of it signals that management sees dilution as the only funding mechanism for the foreseeable future. That guarantees severe multi-year erosion of shareholder equity, regardless of any operational fixes. You're asking shareholders to accept their ownership being perpetually fragmented.
It's the harsh reality of operating in this sector after a sudden political reversal.
And look at the governance side of it.
The desperation is obvious in the push to align their charter with Delaware law for, quote, more achievable voting standards. This move, while they present it subtly, is clearly preparing the board to more easily approve a reverse split if the price can't stay above $1 on its own. So yes, dilution provides a runway, but it's a runway to an even more fragmented ownership structure. And it's greasing the wheels for a future reverse split that will dramatically harm retail holders.
Aligning with Delaware law is often just standard corporate practice. It simplifies complex voting thresholds. I mean, if a reverse split becomes necessary, it'll be because of the stock price and NASDAQ rules, not which state's charter they follow. Management is just securing all the tools they might need in a crisis. That's what disciplined leadership does.
Securing the tools to make shareholder destruction easier. My final point really focuses on the operational strategy itself, which I believe is trapped in this devastating catch-22 that was exposed in the Q3 results. To get that 53% reduction in cash burn you mentioned earlier, management aggressively slashed capital expenditures. CapEx was down 52% year over year.
Again, that was necessitated by the DOE loan being frozen.
And that necessity highlights the core weakness. Plug is a capital-intensive company. It needs to build hydrogen production plants in Georgia, Tennessee, Louisiana to reduce its disastrous fuel margins and finally achieve profitability. By choosing to prioritize short-term cash preservation over CapEx, the company is delaying the construction of the very facilities it needs to fix its fundamental problem. They're sacrificing long-term viability for immediate survival.
That's a compelling argument, but you have to consider the external forces that force those CapEx cuts. The entire business plan was based on a government safety net that just disappeared. The DOE loan was frozen, and more importantly, the legislative changes under the OOBBA, they accelerated the end of certain tax credits and put in these highly stringent, very costly, hourly matching requirements for hydrogen production.
And what does that mandate mean for them specifically?
It means they can't just buy renewable energy credits over a year to qualify anymore. They have to prove that the clean energy was generated in the very same hour that the hydrogen was produced. That requirement fundamentally broke the economics of their original green hydrogen plan for several sites. So the CapEx cuts are not just about saving cash, they're about killing projects that were based on a now defunct policy.
So they abandoned their core business to survive. The data center pivot and that $275 million asset sale should be seen for what it is: liquidation. They're selling off grid connections, which were basically their crown jewels for hydrogen production, to data center developers. That's cash flow from investing, not operations, which just proves my point that they can't fund themselves by actually selling their product.
I disagree with the term liquidation. It's tactical flexibility to adapt to a broken political reality. The pivot lets Plug attach itself to the huge AI infrastructure theme, attracting a whole new class of institutional, mercenary capital. It generates liquidity while the core hydrogen economics are broken by politics. It's a pragmatic necessity, and it allows them to keep funding the refinement of their fuel cell technology, which is still a valuable core asset.
Delaying the build-out means the fundamental loss per unit persists indefinitely. The tactical fixes were brilliant for liquidity, I'll admit, but they confirm the long-term profitability model is still fundamentally broken.
My position is still that the pivot to operational discipline, the successful debt refinancing going from that crushing 15% rate down to a manageable 6.75%, and that critical cash injection from selling assets have, together, created a vital, if narrow, window of opportunity. The risk is still exceptionally high, but the moves they made in late 2025 were the only way to avoid an immediate crisis and reposition the company for potential success, as long as Project Quantum Leap can actually move those margins toward break-even. They bought themselves critical time.
And I reiterate that the structural problems, that deeply negative gross margin, the unavoidable need for dilutive capital shown by the 3 billion share proposal, and the mechanical price suppression from the convertible arbitrage, they all outweigh the tactical cash fixes. The company is trading its long-term viability, shown by the CapEx cuts, for short-term survival. At the end of the day, this is a highly speculative, distressed restructuring story, not a growth investment.
So we've explored the real clash here between the absolute necessity of these recent cash raises and the very real structural ceiling created by the convertible bond hedging. I think the analysis confirms the future of Plug is truly binary. It hinges on both management's execution and external conditions, and it demands that anyone interested really understands this complex interplay between retail sentiment, corporate governance, and advanced market microstructure.
The tension is clear. Short-term liquidity is secure, but the long-term cost of that liquidity is potentially fatal to shareholder value. They've built a runway that is simultaneously being shortened by dilution.
Thank you very much for hearing us. Let us know in the comments what is your opinion, and if you want us to analyze other stocks, don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.